Everywhere you look, things are going up. By the end of 2020, the COVID-19 financial crash was a distant memory. Gold, up. Bitcoin, up. Tech stocks like Tesla, up. Copper, miners, all up. And yet, the real Australian economy is the weakest it has been in a generation. Unemployment hit a 22-year high last year. The economy is emerging from its first recession since 1991. And for the first time in Australian history, the authorities have dropped interest rates to near zero and begun quantitative easing. The gap between the real economy and the financial markets has never been bigger. It's getting more extreme with every passing day. And according to Greg Canavan, Editorial Director at one of Australia's largest independent financial publishers, it's about to have a dramatic impact on your money.
What we're seeing is the start of a lot of money panicking out of the banking system, escaping cash. In 2020, it sent Bitcoin, gold and tech stocks through the roof. Today, I want to show you where I think that money is going this year.
If Greg is correct, the rapidly rising markets we're seeing right now are the start of a much bigger trend. One that could help you capitalise on the next wave of stocks to shoot up, or find you trapped in cash as the stock market moves higher.
If you've been watching Bitcoin and tech stocks roar higher and think you've missed the big move, don't worry. You don't have to speculate in any of that stuff to take advantage of this market. You can be much smarter than that. But you do need to wake up to what's happening, or you risk getting left behind.
Greg believes we're in the early stages of a trend that will impact everyone in Australia in the coming years. Billions of dollars are starting to panic out of cash and rush headlong into the stock market. There's a very simple reason for this, one that we've seen play out before. In at least 4 international markets in the last decade, this panic out of cash has resulted in a money migration that sent stocks soaring higher than anyone would have thought possible. It sent the Nasdaq up 300%, the S&P 500 up 200%, and the UK's FTSE 100 up 100%. Now, Greg believes it's Australia's turn. So no matter how much cash you have to invest, how old you are, and whether you're an investment veteran or a novice, Greg believes it's crucial you understand this phenomenon before you do anything with your money. Not only that, he'll show you exactly what he believes you need to do with your money this year to capitalise. He'll show you why, as counterintuitive as it sounds, right now could be the best time in decades to own Aussie stocks, reveal which sectors could prosper the most, and name the #1 stock he believes you need to own. Not only that, he'll reveal the big money mistake he believes many Australians are about to make with their money without even realising it. So turn up your speakers, turn off any distractions, and prepare to understand the idea that will reshape Australia.
Hello, my name is James Woodburn. I'm the head of Port Phillip Publishing, one of Australia's biggest independent financial publishers. Welcome to Life at Zero. As Greg Canavan is going to explain, right now you stand at a fork in the road. One path could see you make the most financially from life at zero. The other could see you fall behind, watching on as others have some of the best years of their life. Our goal today is to help you make the right decision for your money, your retirement, and your family. With that in mind, let me introduce the man making this prediction today, Greg Canavan.
Woody, it's great to be here. And that fork in the road you just outlined isn't imaginary, it's real. Depending on what you do today, the next few years could be very prosperous or a real nightmare.
That's a pretty bold way to begin, Greg. So let's dive straight into why you're so convinced that's the case. What's going on that's driven you to call this Life at Zero event?
Have you ever heard that phrase, nothing is as permanent as a temporary policy? Well, it's pretty apt for right now. You probably know how the authorities responded to the pandemic. They cut interest rates to near zero. And for the first time in Aussie history, they began pumping money into the financial system via quantitative easing. In theory, these are temporary measures, but I think they'll be around for a lot longer than people realise. In other words, I think life at zero is going to last a long time.
And that's going to see a panic out of cash and into financial markets?
Panic, migration, escape, call it what you want. It's already happening. Gold, silver, Bitcoin and many tech stocks went vertical last year, while most of the world was in lockdown.
And you think that's the beginning of a much bigger move, even here in Australia?
Particularly here in Australia, Woody. As I said, we've never had interest rates this low or QE in this country before. History tells us these policies will create a very clear set of winners and losers, and I think the losers will be anyone holding cash. As people wake up to that, you're going to see a lot of panic as people feel forced to put their money in the stock market.
And that's going to send the stock market soaring even higher than we saw in 2020.
That's what I'm predicting. We've seen this play out overseas before. And if those other markets are any guide, a lot of money will rush out of cash and into the stock market. So if you're sitting at home thinking you've missed the boat on the big recovery in stocks, don't worry. There's still time to capitalize on what's going on. And you don't have to buy super speculative stocks either. If you're smart about it, and if you follow the advice I'm going to share with you, I believe you have a good shot at getting ahead this year.
Now, this isn't at all what people will be hearing in the mainstream media, Greg. I think a lot of people will be looking at the emergency stimulus and watching stocks soar and think, this is going to blow. I'm waiting this one out in cash. What do you say to that?
Yeah, look, I sympathise with that. It feels rational to think that way, doesn't it? But you could have made the exact same argument to stay out of the market after the global financial crisis. And what good did that do you? Think back to 2009. We didn't have zero rates back then, but the US did, and it flooded the world with cheap dollars.
I remember, despite all the grim data, that sent US stocks on a tear, and it helped propel the ASX higher too. Taking a safety-first approach and sitting in cash just meant people missed out on a massive bull market. But I suppose the big question is, what can everyone at home actually do about this? Life at zero impacts everyone. So what do you recommend people do?
Well, there's a smart way to play a situation like this and a dumb way. The dumb way is what a lot of people will do, or actually already are doing. And that involves buying something super speculative like Tesla, and they might make money, but they'll be taking massive risks that will likely end in tears. Instead, I want to show you how you can invest in this market without taking such extreme risks.
There are still risks involved though, surely.
Yeah, you're right. I don't mean zero risk. Anytime you invest in the stock market, you're taking a risk. But you can be smart. Understand the risk you're taking and buy stocks at lower prices, stocks that could rise in the future, rather than buy stocks that have already doubled or tripled.
And that's what you're going to share with everyone at home today?
Yes, I'm even going to share a free stock recommendation in a second. So everyone will walk away with something valuable just for hanging around.
I know that's a very bold prediction to make, but Greg is deadly serious. And as anyone who has followed his work for any length of time will tell you, Greg isn't given to exaggeration. As I mentioned at the start of this broadcast, Greg is the editorial director at our business. We're one of the biggest independent publishers of financial advice in Australia with tens of thousands of readers. We'll tell you a little bit more about what we do and why so many people follow our work in a second. But I bring Greg's role up because he's in charge of all the research we produce. His role is to make sure everyone who reads our work gets world-class advice. And that is a big part of today's event, because there's never been a more critical moment to have unbiased, smart, and independent financial advice than right now. Greg has worked in finance for almost 2 decades. He was an equity analyst at National Australia Bank. He started his own financial research business. He's appeared on the television many times to give his views on the markets. Now, Greg, I know that integrity is very important to you. So why are you putting your reputation on the line today to predict that we're at the start of a big move higher in the stock market?
Because I know that a lot of people are going to find themselves effectively forced into investing in the stock market in the coming years. And I want to help people who feel like their hand is being forced. I want to help them to be smart about it, to be in control, and to understand the risks. And I've never been afraid to take a risk when it's something this important. For example, I called bullshit at a former business when I found out about some bad decision making. In fact, I was so vocal I was fired a month before my daughter was born. To be honest, my wife wasn't very happy about that. But if you value your integrity in this industry, you need to be willing to say what you think. And that's what today is about. Helping people understand what's going on and to do the smart thing with their money. But I want to help people do it in the right way. I don't want to see anyone taking crazy risks. I want to help people grow their money as safely as possible. And if things go well, then yes, there's real money to be made here.
Now, Greg, we've only been on air a few minutes, but you've already made several fairly eye-catching statements. Zero interest rates and QE are here to stay. A lot of money is going to panic out of cash and into stocks, and that's going to send stocks grinding high, even in the face of a terrible economic situation globally. And you think this process has already begun with Bitcoin, gold, and many stock markets hitting all-time highs in the last year. But I'm sure everyone at home is thinking, what makes you so confident that you're right?
Because, Woody, I've seen this exact situation play out before. Look, I don't have a crystal ball and I can't see the future. But understanding the situation in Australia today isn't just about blindly guessing. It's about understanding the recent past. So take a look at this chart on the screen. It looks like the kind of thing we all want to invest in, right? And as you can see, this market has been on a tear for more than a decade, but it's not all as it seems. So this chart shows the Turkish stock market, known as the Borsa Istanbul 100. And as many people will know, Turkey has been a terrible place to invest in recent years. This is an economy that is well and truly falling to bits. The economy is in recession, unemployment is through the roof, and borrowing is skyrocketing. And yet, the market has quadrupled since the GFC. So it doesn't quite add up, does it? But although the market appears to be rising higher, even in the face of terrible economic data, when you look at the same market measured in US dollars, you see what's really happening. So that chart on screen shows the same Turkish stock market priced in US dollars. And when you look at it like that, it's a bloodbath. It's been one of the worst performing markets in the world over the past decade. So what we're seeing here, this is the untold story, is money flooding out of Turkish bank accounts and into the stock market. Now, I'm not predicting that Australia is going to become Turkey. We have our own problems, God knows, but they're nothing on Turkey's. I tell you the story because it perfectly demonstrates the principle behind what I'm saying.
Effectively, this was a flood of money out of the Turkish lira bank accounts and into the stock market. So stocks soared, but that masked the bigger move, which was the collapse of the currency. That said, the story you just told raises a logical objection. Australia isn't Turkey. And as you said, a saver in Istanbul has a completely different challenge to face than our readers here in Melbourne, Sydney, Perth, wherever. So doesn't the comparison fall apart?
Not at all, Woody. Turkey is just a dramatic example of what I'm talking about. But once you understand it, you'll find that a lot of what's happened around the world in recent years starts to make sense. And crucially, you start to see a roadmap for where Aussie markets could be headed. So it goes back to the point I made earlier. When we get conditions like this, we see a panic out of cash and into anything that might hold its value. That starts as a trickle, as small numbers of people wake up to what's happening, but it slowly becomes a flood as people are forced into the market. And to be clear, I am predicting this will happen right here in Australia.
It's something I imagine is nagging away at our viewers already. Life at zero means cash savings don't pay that much. That's fine for a month or two, but the longer it goes on, the worse things get. And it's not as if you can just do nothing. Research from Westpac analysts suggests rates in Australia will remain at zero until December 2023. That's a long time to wait.
Well, it wouldn't surprise me if it was a lot longer than that. And it will probably be a decade before rates go anywhere close to normal, whatever that is. So let me use an example that's a much closer comparison. How about the biggest economy in the world, the US, right after the global financial crisis? As everyone knows, by 2009, there'd been a terrible bust, a banking and housing collapse, and millions of people were out of work. And the Federal Reserve was bent on solving that situation. So the Fed pushed rates to zero and started a massive program of quantitative easing.
In other words, they did exactly what the Reserve Bank of Australia did last year.
It's the same playbook, yes. And a lot of people have seen all this bad news and thought it was time to bunker down, wait for things to improve, and sit in cash. Maybe they even thought the market would crash again and there'd be a buying opportunity in the future. I mean, it feels a rational thing to think, right? But it was wrong, and massively so. See, this is what you really need to understand. Dropping interest rates to zero and pumping new capital into the financial system isn't just a minor change. It completely rewires the entire system, and it creates a very clear set of winners and a very clear set of losers. Anyone left sitting in cash got little to no interest, and meanwhile stocks soared. This chart shows you what I mean. It's a chart of the S&P 500, which is the largest stock market in the world. Now, it rose 200% in the first round of QE, which was from roughly 2009 until 2015. And then it rose another 70% in less than 1 year during the second round of QE in roughly 2019. But individual sectors, particularly technology, rose even higher than that. For instance, the tech-heavy Nasdaq index increased by 300%, and a massive well-known stock like Apple rose 1,200% off the back of these low rates. So a 10,000 stake in 2009 was worth 130,000 a decade later, and that was in a large cap stock. But how many people actually made gains like that? Not many at all. And that's because a lot of people have sat in cash and waited for things to improve before they got into the market. And in the meantime, many of the stocks they wanted to buy more than doubled.
In other words, the market went turkey. Sitting in cash was a disaster. Owning stocks was, as counterintuitive as it sounds, the right move. Of course, there would have been some stocks within that index that didn't rise. That's the nature of the market. But the overall trend for the market as a whole was up. Now that example strikes a lot closer to home, but there must be more.
Yeah, there is, Woody, and the same thing happened in the UK. Let's go back to 2008 again. The UK economy was on its knees post the GFC. There was a recession, property prices had crashed, and unemployment spiked. It was, every way you look at it, a terrible economic situation. So the Bank of England, which was the English central bank, dropped interest rates to near zero and began pumping capital into the financial system via quantitative easing. And what happened? The stock market ground higher for the next decade, as this chart shows. It's clear, the winners owned the stock market, but the losers were the people who sat in cash and waited for things to improve and for rates to normalise. And that never happened.
It's that same pattern again, isn't it? A soaring stock market in the face of seemingly grim data, and savers getting crushed without even realising it.
So you've heard the analogy of the frog in boiling water, right? If you put a frog in a pot of boiling water, it jumps straight out. But if you put a frog in a pan of cold water and slowly raise the temperature, the frog doesn't realise until it's too late. If you want to survive life at zero, you need to understand that sitting in cash makes you that frog. It forces you to make a decision, because doing nothing is one of the worst possible things you can do.
And the worst part, I imagine, must be when those savers look back years later and realise they were duped. They've been hurt not once, but twice. Not only do their savings lose their value every day, but they're forced to watch as markets march higher. Imagine it, hearing your friend or neighbour has made 50%, 100%, 200% on their money in the stock market, while your money goes backwards. That's what Greg means when he says falling behind. It's a divisive trend where there are very clear winners and very clear losers. And really, what we want to do is to help you be a winner.
Yeah, exactly. Look, let's make this really simple for everyone. Zero rates and QE are going to stay for longer than anyone expects, just as we've seen around the world since the 2008 crash. This is going to force a migration of money into the stock market and hurt anyone who sits in cash for too long. Now, it might sound like madness, but you can make money from this situation. You have to be smart, you need a plan, and you'll need to hold your nerve. But you can come out of this on top.
All that said, I'm sure a lot of people are looking at the mess the world economy is in and thinking, I want no part of this. It's all going to blow up one day. What would you say to those people?
Yeah, Woody, I would say I completely understand that impulse. And to be honest, the system is blowing up. It's just that people don't recognise that rising stock markets are a part of this process. The destruction is in the value of the currency, not stocks. Look, having a central bank that feels compelled to try to fix things with loose monetary policy isn't a good thing. I'm opposed to it. But here's the thing. The market does not care what I think. What should happen is irrelevant. The point isn't to get the market to agree with our views. It's to make money, to move our financial position forward, to keep our retirement or savings accounts growing, whatever your goal is. And all the facts in front of us suggest life at zero is going to kill savers and drive certain stocks higher. You might not like it, but that's what the evidence suggests.
You sound like you're talking from experience, Greg.
Yeah, well, I certainly am, and I'll give you an example, Woody. So back in 2001, I got very interested in gold. It was cheap and hated at the time, and to me it represented real money. It couldn't be printed or devalued, and I liked that. So I piled in, and not just to gold, but to gold stocks too. So I won't go into too much of the detail here, but but over the course of the next decade, I made a lot of money in this trade. Then in 2012, something went wrong. Gold entered a bear market, although I didn't really know it at the time. I'd been right for so long that I just didn't see it coming. And the world was awash in cheap cash after the GFC. And my view was that could only send gold prices rising higher. And I held on to that view even when prices started falling. It wasn't so much a view as it was an inbuilt bias. So even as gold prices dropped, I held on. I was blind to what was happening. I was too wedded to a belief.
But long term, you did well. Gold recovered and made new highs last year. So it wasn't such a disaster, was it?
Yeah, but that misses the point, Woody. I could have seen what was going on, taken my profits and moved my capital somewhere else where it could have grown. So think about it like this. There are loads of people out there that claim the financial system is broken and there's a big bust coming in the future. But what I'm saying is, if you look at Turkey or Argentina, for instance, you see that rising stocks are a part of that bust. Sitting in cash while it goes nowhere and stocks rise is a bad move. It feels counterintuitive, but that's what the evidence suggests.
And that brings us to today.
Yes, it does, Woody. Look, you might think what's going on in financial markets right now is crazy. You might think zero interest rates and QE are examples of the state overreaching itself. And you might think this should all end in disaster. But once again, what should happen is irrelevant. It's what is happening that counts.
It reminds me of the property market, both here and where I grew up in England. For as long as I could remember, people would tell me that prices should soon start falling. This was during a big property boom, and I knew people who waited and waited because they thought prices should correct.
Yeah, that's exactly right. And did they? No, they just kept rising. I was a victim of that thinking too. The median house price in Australia has increased something like 400% over the last 25 years. And it rose in the face of plenty of people who claimed that it should correct. To me, that way of thinking is dangerous. It's letting your personal bias get the better of you.
And most of those people who waited ended up buying in, just at much higher prices.
And the exact same thing is going to happen in the stock market. You just watch. That's my prediction. The ASX is hovering just below its all-time high, around the 7,000 point mark. I think before long, it'll break that barrier and it'll just keep heading higher. Anyone waiting around for a big crash and a perfect buying opportunity is going to kick themselves. So I'd urge anyone watching not to make that mistake. Right now, I reckon you've got a big opportunity to get in early on a big bull market in Aussie stocks. You don't have to go crazy. You don't have to buy tiny tech stocks or cryptos. If you're smart and you buy the right stocks, I think there's money to be made. The thing is, my whole goal here is to show you how you can, in a relatively low risk way, start building a sizable portfolio by owning the right Aussie stocks today.
We'll talk specific stocks soon. And of course, you're going to name one of your top stock recommendations on camera in a second, free of charge. But first, anyone reading your work recently will know that you've been banging the table about stocks, particularly Aussie stocks, for months now. Can you quickly lay out your case?
Sure, Woody. Look, there's basically 4 key reasons why everyone watching should be getting interested in stocks right now, beyond the bigger picture that I've laid out today. So let me quickly talk you through them. Then we'll move on to what you can actually do to profit from all this. The first is very simple. Australian stocks are at a 30-year low when compared to US stocks. Have a look at the chart on screen, which illustrates it. It basically shows that Aussie stocks haven't been this cheap compared to US stocks in a long, long time. We're talking decades. And a big part of that is interest rates. Rates in the US have been at record lows for the best part of a decade, and that sent US stocks soaring. In comparison, the ASX is lagging way behind. It's also a reflection of the big weighting towards tech stocks in the US. Tech is now insanely overvalued in my view, and Aussie old economy stocks, not so much. So if history tells us anything, it's that extreme lows like this are great buying opportunities. And we haven't seen one this good in 3 decades. And that brings me to point number 2. Though we're massively lagging the US, the ASX is approaching a new all-time high. This is a very bullish sign. Last year, the market hit 7,000 points, only for the pandemic to slam it into reverse. Now, the next time that happens, I expect the market to break higher and to keep on rising. We might not see prices this low again for a long time, if ever. That's because of the third part of my argument. I think low rates are going to stay lower for longer than anyone expects. Just look at the UK. As the chart on screen shows, rates dropped to near zero in 2009 as an emergency policy. And a decade later, they were barely any higher. And now they're at near zero again. And the fourth plank of my argument is connected to this. The dynamic for the Australian markets is bullish right now. But internationally, we're seeing the same thing play out. And Australia is impacted by overseas markets, particularly the US. So if you look at what's happening there, you can see the writing is on the wall. The Federal Reserve has promised to keep rates at zero for the foreseeable future. And Joe Biden has hired the queen of low rates, Janet Yellen, who was the former chairman of the Federal Reserve, as his Treasury Secretary. And they're already planning a spending blowout. In other words, they're going to flood the market with more and more dollars, and that's likely going to send prices even higher.
So you don't expect a correction, Greg?
Look, all markets rise and fall. We'll see lots of corrections before this cycle is over. If you're going to buy stocks, you must be prepared for that volatility. It's just part of the game. But the point is, anything major, and by that I mean falls of say 20% or more, is just going to be met by more official attempts to prop things up. QE will seem like conventional policy by the time we're done with things. And that'll lead to more currency debasement that will actually just wind up driving the markets even higher.
Greg, I think you made a compelling case. To summarise what you've been saying, life at zero is going to hurt cash savers. If you want to avoid your money going into reverse, you cannot sit in cash. That's going to send increasing amounts of money flowing into the stock market. And a lot of that is going to be what you might call dumb money, people chasing hot stocks and speculating wildly. You've made it clear you think that's the wrong way to go. So let me ask you this. How do you be smart about investing in a market like this?
That's the question I've been pondering since the pandemic began. Because you have to be smart. I mean, this is your money. You've worked damn hard to save it. You need to respect that and take calculated risks with it. And I think I know a way of doing just that. I put it all down in a new report called Surviving Life at Zero, a Roadmap.
Yeah, I've just finished reading a copy of it, Greg, and I know you want to share this report with as many people as possible. Tell us more about what people will find out when they get their hands on a copy.
Yeah, absolutely. Remember my goal, to help you make the smartest, most profitable decisions you can make right now without taking crazy risks. So the first thing you'll find is a 3-part stock screening strategy I've come up with to help you pinpoint potential winners. I said earlier, I know a lot of people will be nervous that they've missed the big rebound in stocks. That's not true. But you need to understand how to find the stocks that are just beginning their uptrend, not topping out at insane valuations.
And on top of that, you've pinpointed 4 specific areas of the stock market you're watching for the best returns in 2021. I know from experience that when you hear about a particular kind of stock leaping by 3 or 4 times very quickly, it's hard to not want to chase it higher. So where should people be looking?
At the areas of the market that haven't boomed yet. Remember, the market is like a living thing. It breathes in and out. What's hot at any time can rapidly change. But right now at least, I think there are 4 areas of the market that have the potential to rise in the years ahead and outperform the market. Broadly speaking, I'm talking about energy, financials, industrials, and utilities. You have to look at the roadmap for specific details, but each sector has underperformed the market significantly in recent years. In the case of energy and financials, they started to outperform at the end of last year. Capital is now coming back in on the basis of an improving economy and attractive valuations. Industrials and utilities are not quite there yet, but they're very interesting to me because no one likes these sectors right now. People are too busy chasing the latest hot stock. And when you see this type of setup, it's a recipe for strong future returns. So that's a focus for me in 2021.
And of course, a lot of people will be thinking, that sounds great, but what specific stocks should I buy to take advantage of your work?
Yeah, I can help there too, Woody. You see, I've been building an entire portfolio dedicated to coming out on top during Life at Zero. And to introduce people to it, I put together another report called 3 Stocks to Buy for Life at Zero. The title pretty much says it all. It shows you which stocks I reckon you need to own now to benefit from what's happening.
So how do you go about picking these stocks then, Greg? It must be more than just analysing the big picture.
This process, if you want to call it that, is the same way I've been advising my readers to invest for the last 5 years, with a few tweaks I've made to reduce risk and improve performance. It goes back to the idea we discussed earlier. The market doesn't care what you think, and that goes for everyone. So I've just laid out the roadmap of where I think money is going to be made next. But I could be completely wrong. What I think is only half of the equation. The other half is what the market thinks. And a lot of people seem to miss this point entirely. They're so convinced they're right that they ignore what the market is telling them.
And how do you know what the market thinks?
You watch share prices, Woody. I look at hundreds of charts a day. This tells me which stocks and sectors are rising and what's falling, where the money is flowing into and where it's flowing out of. This information tells you a lot. And when those technical indicators match your own fundamental views, you know you're onto something.
So you're really talking about using technical analysis to help you make your decisions?
Yeah, exactly. It's the fusion of fundamental analysis and technical analysis that works in my experience. So yes, I think the 4 sectors outlined are the best sectors for right now. But before I pick a stock in those sectors, I'll wait until we're in a clear uptrend. You want to see signs the market is moving higher before you make your move.
Give me an example of what you mean, Greg.
Yeah, why don't I bring up a quick chart here. So this is a company called Computershare. It's a big, large cap stock here in Australia. It's not particularly sexy. It's involved in, financial services. It's not some small specky stock that could make you, 10 times your money or 4.95%. But I recommended it a few years back and it gave my readers the chance to make 66% in a couple of years.
What made you recommend it?
There were 2 things. I thought there was a strong fundamental case to be made for the company. So that was the first thing that I looked at. But I didn't buy it until I saw the stock price pick up. So I saw the 50-day moving average cross the 100-day moving average, which is a bullish signal. It's not on the chart that's on the screen now, but it's one of the indicators that I do look at. And when that happened, it validated my view, so I bought it. And a couple of years later, we walked away with a nice gain. Let me give you another example. The chart on screen now is of Saracen Mineral Holdings. It was a smaller gold stock at the time, and I've actually recommended it twice in the last few years, both times for gains. So I used the same technique that I told you about with Computershare. I had a strong fundamental view on the company and the wider gold markets, which were turning up at the time. But I didn't pull the trigger until I got a bullish signal on the chart. To repeat the point I made earlier, it's no good having a fundamental view that the market disagrees with, and watching the charts helps us validate our views. So in this case, when I saw the charts break out, I moved and put a buy recommendation on the stock. So the first time I recommended it, Saracen, the stock made 155%. And then we got out when it started to fall, and we got back in when it started to rise again. And the second time, my readers had the chance to make 242% gains.
Well, it feels like a very rational approach, Greg. Fundamental analysis plus technical analysis means you have a view of the wider markets, but you're waiting for the market itself to validate that view. It feels smart. I saw your portfolio also had a 204% win on West African Resources, a 50% profit on Illumina, and a 76% gain on Elders Limited, and another 76% gain on Cymit.
Yeah, and just to cut in there, Woody, it's worth pointing out that all those winners came in the space of a couple of years or less. So you need to keep that in mind when investing in Aussie stocks. Our market just isn't big enough for a business to have a 10-year product rollout or something like that. The cycle is always going to be a little bit shorter here. So you need to keep your eye on a possible exit at all times, whether that's to lock in profits or to take losses. And I do have losing stocks in my portfolio. I really don't want to hide that or pretend that any of this is risk-free. It's not. There will be some losses in the future too. Even in a strongly rising market, you can get it wrong if you own a stock that goes down. But that's just a part of investing. But given the macro picture and the outlook for cash, I think it's time to take calculated risks.
And that's the perfect time to tell you how you can get your hands on all of the research Greg has put together to help you understand and profit from life at zero. Remember, in a second, Greg will share the name and ticker symbol of his number one stock for right now, right here on camera. That's coming up, so stick around. But as you've guessed, this is about much more than one stock. If Greg's right, we're all going to be living life at zero for a long time to come. That means everyone needs a smart plan to make the most of what's happening and to avoid falling behind. And that's what Greg has put together for you. It starts with a comprehensive research report called Surviving Life at Zero, a roadmap. In this report, Greg details what he expects to happen in the near future, why he thinks markets will keep grinding higher, and why any serious correction will be met with even more money printing. Not only that, Greg's also put together a second report called 3 Stocks to Buy for Life at Zero. Here, Greg shares the 3 stocks he recommends you buy right now to position yourself to profit from life at zero. But I know that if you're a novice investor, you might well be thinking, this all sounds great, but I just don't know where to get started. I get it. The financial markets can be a confusing place, but that shouldn't hold you back. That's why Greg and our editorial team have put together a guide called A Beginner's Guide to the Stock Market. This does everything you'd expect it to. It walks you through what you need to do to get started, from choosing a broker, buying your first share, and understanding risk. It's invaluable reading. In fact, even if you've been investing a while, I recommend reading it. The good news is both of these reports can be yours today. Just stick with us. They both come as introductory gifts as part of Greg's monthly investment letter, Greg Canavan's Investment Advisory. Now, if you've been nodding along as Greg has been talking today, then I think you'll love Greg's work. It's your invaluable guide to making smart decisions with your money. And there's never been a better time to subscribe than right now. Every month, Greg explains what's going on in the financial system, what it means for Australian investors, and shares fully researched stock recommendations you can use to profit. You've seen a number of his past recommendations today, but you don't have to take our word for it. Here's just what 3 of Greg's current subscribers have to say about his work. I love reading Greg's articles and believe him to have one of the most solid, interesting, and well-reasoned viewpoints out there. In short, I can relate to and therefore trust what he has to say. I know that 80% plus of everything I have invested in has done well so far. And this subscriber says, in a crazy, greedy world, it's so damn refreshing to have such common sense and balanced views and recommendations. Greg's got an astute head for where the world is going and a heart to boot. Love it. And then this subscriber said, Greg, you're one of my most trusted analysts. I love reading your well thought out views on the big picture as well as individual stocks. Thanks for all the work you do. Well, today you have the chance to join these existing subscribers and get all of Greg's advice going forward. And I think that's going to be extremely valuable. The reports Greg has put together help you understand and position your money for right now. But we know the markets can move quickly. One thing we know we can expect, and 2020 proved this, is that life at zero can be volatile. Stocks could correct 20% or leap 50% or 100% higher. Knowing what to do in those situations is critical. Holding your nerve and doing the right thing won't always be easy. If Greg is right, we'll see corrections along the way to new highs. Lots of people will be spooked by that. They might panic and do the wrong thing. That's why reading Greg Canavan's Investment Advisory is so valuable. It means you have an experienced guide in your corner to help you understand what's going on and make the right calls. You see, Greg will provide you with specific stock recommendations, buy advice, but he'll also write to you with regular updates on what's happening with the stocks he's recommended. And when the time comes to take profits or cut losses, he'll be there to give you sell advice. In other words, you're never on your own. You'll always have Greg on side, either in his monthly reports or in weekly updates by email to share the latest thinking with you. The good news is you can get everything I just told you about as part of a subscription to Greg Canavan's Investment Advisory. Remember, accept this offer and you'll get everything I just told you about right away. Your report, Surviving Life at Zero, a roadmap. Greg's companion report, 3 stocks to buy for life at zero. Your copy of A Beginner's Guide to the Stock Market. Plus, you'll get one extra bonus gift that I haven't yet told you about. Now, it's a book that Greg has written Greg, why don't you tell us about your book?
Sure, Woody. So the book's called You, Your Brain and the Stock Market. And it came about a few years ago after a pretty nasty personal experience I had in the market. That ended up losing me a lot of money. And I realized that the reason why I lost a lot of money was my own mental biases and my own emotional responses to certain things in the stock market. So what I wanted to do was to really sort of pull that apart and write a book that explained a lot of the stuff that goes on in investors' heads. And they're typically the same mistakes we make over and over and over. And unless you're aware of how your, emotions can destroy or make your investing decisions a lot worse than they should be, you tend to make those decisions over and over again. So the book is really about your ability to sabotage yourself in the stock market. And if you understand those issues that you have, you can fix them and become a better investor.
And I guess one thing I would say is that it's never been more of an important time to have that kind of resource at your disposal. What with the markets doing what they're doing, and that separation between the currency and what stocks are doing.
Absolutely. And I think one of the really important things for people to understand is that a stock price is partly fundamental value driven and partly driven by people's emotions. I mean, we're seeing that with so many different markets around the world right now. I mean, you've seen Bitcoin go crazy. You've seen anything related to renewable energy go nuts. A lot of those are their emotional influences on a price. So I think if you're aware of how emotions play a part in your own investing, but also in the broader market, you can become a lot more knowledgeable investor and process things a lot more rationally. And if you do that, you're going to not be as stressed, and you're going to have a more pleasant time investing as well.
Thanks, Greg. And you can get a copy of his book, You, Your Brain and the Stock Market, along with a subscription to his investment advisory. So how much does it cost to become a Greg Canavan's investment advisory subscriber? Well, Greg's work is an essential guide to making good decisions with your money. As you've seen, there's never been a more important time to have help and guidance like this. So I want as many Aussie savers and investors to be able to take advantage of his work. And I don't want price to stand in anyone's way. So I've priced Greg Canavan's investment advisory at a rate that I think anyone with money to invest can easily afford. A 1-year subscription is just $199. That comes protected by a money-back guarantee period of 30 days. That means you can try Greg's work out for the next month, read all his research reports, get a copy of his book, and if you're not happy, you can walk away with every cent you've paid. Now, why offer such generous terms? Well, look, I know the financial world can be a confusing place. There are plenty of people out there who'll promise you the world and never deliver. I want you to be able to see Greg's work with your own eyes before you make any long-term decisions. If you like what you see, and I think you will, fantastic. But if you don't, for any reason, I believe you should have the chance to walk away without having lost a cent in subscription fees. That's what this 30-day trial period gives you. And this offer gets even better. You see, though the full official price of Greg Canavan's investment advisory is $199, I'm willing to knock that price down to $99 for your first year as a special introductory offer for new subscribers. Our business thrives when we help our readers make great decisions with their money, meaning people stick around with us for the long term. So I'm willing to discount that first year just to give you an extra incentive to give this a go, because I think you'll love what you see and want to read Greg's work for the long term. Now, there should be a link appearing beneath this video now. Click it. It'll take you to a secure order form where you'll be able to take out your discounted subscription and secure copies of Greg's research reports and his book right away. Though, of course, there's one final thing to cover before you come on board. Okay, Greg, let's look at your number one stock to own right now to capitalize on what's going on.
Yeah, sure, Woody. We'll start with the sector first. And to give some context, the reason why I really like this stock is because it's in an out-of-favor sector. It's only just starting to turn around, so we're only just starting to get some interest back in. We've spoken about stocks that have doubled and tripled in price. This is a stock that's still quite low, some really good value, which I'll get into in a moment. But it's in the oil and gas industry.
So it's one of those old economy stocks.
Yeah, absolutely. And if you look at how people view oil and gas and fossil fuels, it's completely out of favour. I mean, people are looking at this sector and saying, will it survive in 5 or 10 years' time? And true, renewables are going to come in and they're going to have an impact on demand. But what a lot of people aren't looking at is what the impact on the supply side is going to be as well. So companies that produce this stuff, produce oil and gas, they're not investing in future oil and gas production. And the only way that that's going to happen is if you get rising prices. So one, I think oil and gas prices are going to be rising considerably in the years to come. And secondly, the stock pick that I've got for people today is clearly leveraged to this sector, but it's also got rising production itself. So there's effectively a double leverage going on here. We've got rising oil and gas prices and rising production to take advantage of that. So the stock that I've got for everyone today is a stock called Beach Energy. It's got a market cap of about 2.9 billion, assuming a share price of around about $1.30 a share. So it's obviously a very large and liquid stock. Beach is a very different company to what it was just a few years ago. It's made some strategic acquisitions that have given it a lot more diversity in terms of its production. Back a few years ago in 2016, it effectively was a single area producer with most of its production coming from the Cooper Basin. Now it's got a number of production hubs, Cooper Basin, Otway gas offshore in Victoria and South Australia. It's got production in New Zealand, the Bass Strait, in addition to emerging province over in the Perth Basin. So it's quite a diversified company in terms of its production hubs, and obviously diversified across oil and gas as well, with about 44% of 2021 year-to-date production exposed to the East Coast gas market, and about 32% exposed to oil production. Just talked previously about my sort of, I guess, enthusiasm for higher oil prices over the long term, given the underinvestment, what we're going to see in that sector in the years to come, and the fact that Beach is leveraged to that. In addition, Beach has its own growth pathway. So they've got a number of growth projects that they're investing heavily in at the moment, in the Otway Basin, the Perth Basin, and also the Bass Basin. So just taking those projects and looking at where the production uplift is going to come, you've got the expectation is by 2025, the Otway Basin will be producing an additional 5 to 5.4 million barrels of oil. In the Perth Basin, the Waitsia Gas Project Stage 2 will start contributing from the second half of 2023, an additional 5.5 to 6 million barrels of oil. And in the Bass Basin, the Trefoil project there is expected to contribute 2 to 2.2 million barrels of oil. So obviously that sort of growth comes at a short-term cost. Beach has got to invest quite a bit of capital into those projects, and that's not without risk. You don't just put the money in and sit back and wait for the returns to come. That often does happen, but obviously there are risks involved in these large-scale investment projects. But taken on balance, I think, from a risk-reward perspective, you're looking at significant growth over the next couple of years, the potential for significant production growth over the next few years, combined with what I think will be a robust oil and gas prices as well. So that bodes well for the company. Just before I get on to the valuation aspect, it's worth pointing out and having a look at the chart, because in recent times, Beach has had an issue. Back in late April 2021, it did announce a downgrade of what it calls its Western Flank oil assets. So pretty much what happened, just to give you a quick bit of background, the Western Flank is quite a large production area for Beach in the Cooper Basin. Back in, I think it was 2016, production started, the wells started to decline quite sharply from there. And it was a bit of a concern because around that time, this was the main production hub for Beach. So the market was very, very negative towards it. They did put some money into additional exploration, drilled some horizontal wells and found some additional reserves there. And Western Flank effectively turned around and hit another production peak in 2020. So there was a lot more oil there that they managed to discover and pick that asset up. But what's happened this year is that the oil fields that they discovered back in 2016-17 have started to decline sharply again. That's come as a bit of a shock to the market. When the company announced that, the share price fell quite sharply. I had a good look at the announcement. I listened to the call from management, and my view is that this still represents a good risk-reward opportunity. And you can see there on the chart, the share price has fallen quite sharply. I don't expect that to bounce back, anytime soon. I think you've got to understand that once share prices do have a sharp fall, they do take some time to consolidate before they can move higher again. So the reason I still am happy to tip this stock is I think there's a lot of potential over the next 2 to 3 years, which is what your holding period should be for this type of service. It's not a trading service. We're not looking at getting in and out of stocks. We're looking at buying what I think are undervalued assets and holding on for the re-rating. And sometimes you just have to be patient for that re-rating to come. A couple of things I liked in the wash up of this, even though it wasn't a great announcement, given that it has had an impact on FY21 and FY22 earnings. You've seen the major shareholder, which is the Seven Group, which is run by Ryan Stokes, Kerry Stokes, the billionaire, his son. They were in the market buying heavily on the day that the share price fell sharply. And subsequent to that announcement, there's been a number of director notices to the ASX showing that the directors have been buying as well. Some of those are only small purchases and maybe symbolic, but there's one or two there that are quite substantial and give me a little bit of confidence that the board and those close to the company see this as more of a short-term setback rather than anything that's a terminal problem for the business. So look, Western Flank assets, they are an issue. Beach will be directing more exploration spend into that asset to see whether they can turn that around and extract more value from it, which is entirely possible. They've done that before. But there are additional growth projects that are in train, and I expect them to come online from 2022 into 2023, and production should grow considerably from there. So turning to the valuation, as I said, there has been a downgrade to FY21 and FY22 earnings, but when you look at it, it's still a pretty profitable company. That Western Flank is not the only asset that produces generates income, revenues and income for the business. So even based on that downgrade, when the numbers have come through, the consensus estimates are suggesting that Beach is still going to be generating a return on equity of just over 12%, which is reasonably healthy. And when you look at where the share price is, and currently it's trading at a discount to book value at that $1.30 mark, that tells me you're getting a relatively good risk-reward equation there, which is why I'm happy to buy it. And I think longer term, it's still a really, really good opportunity here. So my valuation sits around about the $3 mark, which is significantly above where we are now. I know the market is not going to pay that at the moment, so there's no point thinking that it's going to get there anytime soon. But I think as Beach demonstrates that it does have the ability to grow production and there's no more major issues coming out of the Western Flank, then I think the re-rating will start to take place. It's not going to happen straight away, as I said, but I think now is certainly a good time to take a position in the company. But I would just stress that it is a relatively high risk stock, given that we are talking about oil and gas assets, exploration, development of those assets, which there are always, there's always the potential for things to go wrong. But It's like any company, any situation, you've got to weigh the risk up with the potential reward. And if management do get this right over the next couple of years, then there's, I think, considerable upside. So that's my stock pick. And as I said, good risk reward, and I think we'll do very well out of it over the next couple of years.
Greg, we've covered a lot of ground today, and I think it's fair to say that the stakes could not be higher. Doing nothing is simply not an option, is it?
Exactly, Woody. I mean, if you sit in cash, I think you're going to regret it. If you speculate wildly, I think you're going to regret that as well. There's just, in this type of market, there's just so many ways that you can get it wrong. But if you get it right, and if you be smart about it, there's a real good chance of making a lot of money here.
It's as simple as that. You could get ahead or fall behind. It depends on what you do today. Greg and I have tried to explain things as simply as possible. Greg has laid out everything you need to know to position yourself to prosper in his report, Surviving Life at Zero, a roadmap. And you can get that report, all the other bonuses we told you about, and Greg's ongoing guidance in Greg Canavan's investment advisory. Now it's over to you. It's your call what you do next. But if you do want to give this a go, and I recommend you at least try it, click the link below this video now. I look forward to welcoming you to Greg's service. I know you'll get a lot out of it. From Greg and me, thanks so much for your time today, and we'll see you again soon.